We are facing a new era of central banks taking one step further in quantitative easing. José Ricaurte Jaén, Guardian Trust FX. The RBA cut its interest rate this week despite the relatively low trend in unemployment and a 3.1% economic growth. What has led to this further cut?
Well, basically what we have here is an adjustment to the new subnormal. We're facing a new era of central banks basically just taking one step further into quantitative easing. And you have an RBA that is just afraid of being in a bad spot. It's trying to avoid facing multiple challenges in the near future. Near future, just 5 years. And in addition, you're in the presence of a central bank saying we are just protecting ourselves from counterparty activity. This counterparty, in fact, being China, and they're continuing the devaluation of the yuan and just adjusting. This is what is happening. So not only the fact that it probably wasn't unnecessary, but it's just the idea of the pre-game against what other central banks may do or don't do in the future.
The Bank of England cut its interest rate for the first time since 2009 to 0.25 from 0.5. Why did they make this cut?
With the Bank of England making a very progressive decision, we're facing another round of challenges in Europe. This cut is just, in essence, a response back, and let's say fire back to the Brexit situation. What Mark Carney is looking here is just to provide enough liquidity to the markets. And in sort of all the stakes in place, you look at FTSE 100 that just dropped 100 points before rate decision. Now, of course, the markets are showing up the situation, and without any doubt, we can look at the indexes to trade way above the highs in 2016. Of course, this will be very interesting as bonds are all over Europe are in a negative interest rate zone. So I think it's just another way for the Bank of England to create some peace of mind in a very uncertain situation.
The ECB has warned of global uncertainty, as the data from the second quarter points to slow global activity and trade. Do you agree with this, and what risks should we be aware of?
Yeah, absolutely. I agree at a certain extension with this statement. However, what we have also is just a disconnected strategy among central banks. You are in the presence of a ECB that's fighting no inflation at all after all the efforts over the last 5 years. And on top of that, probably what we can call the final step will be the Brexit scenario. Now, one of the things that we have to consider, and what they basically call global uncertainty, is the fact that in mid-October they're facing more challenges with a very important partner, in this case Italy, and that's what we have to watch for the next couple of weeks, how the time that Italy is carrying when it comes to non-performing loans, how that drama will end. And at a certain section, we also have to deal with what can be political uncertainty in Italy, and that may affect the rest of the partners in the European community.
Thank you, Jose, for your wrap-up of this week's biggest financial stories. That's all from me this week, but do click back on Monday for the week ahead. Goodbye for now.